So I think that a lot of your viewers who will be gold people, silver people, who are probably very happy over the last few months, but have been buying through thick and thin forever, they relate to not being, in the in crowd. And in fact, when gold and silver in particular was in the in crowd, I want to run away. I want to run away fast. You want to buy silver? Like you got a queue around the block for silver? Buy mine.
You need some hard assets, sound money to properly diversify that portfolio. So, yeah, this cannot be hacked, but what they do is they use the COMEX, going back to the first question, they use those paper contract markets to manipulate the visible price. They don't say this is a spot gold contract. They refer to it as gold or silver, and they can make as much of it as they want to until they can't.
True believers in gold and silver have never needed the crowd's approval. In fact, the savviest hard asset investors will tell you the opposite. When precious metals become mainstream, when headlines cheer and queues form around the block at coin dealers, that's precisely the moment to pause. The real opportunity lies in buying through the quiet periods, through the thick and the thin, when the masses have moved on to the next shiny thing. That contrarian discipline is what separates wealth builders from trend chasers. When gold and silver are the in crowd, I want to run away fast. But here's what most retail investors miss entirely. The price you see on your screen for gold or silver is not a true free market price. It is heavily influenced by paper contract markets, most notably the COMEX, where futures and derivatives trade under the label of gold or silver, yet are entirely detached from the physical metal. Unlike physical bars and coins, these paper instruments can be created in virtually unlimited quantities, allowing large players to flood the market with synthetic supply and suppress visible spot prices. It's a system that works, until it doesn't. That's precisely why owning tangible physical precious metals remains one of the most important tools for genuine portfolio diversification. Hard assets cannot be hacked, cannot be printed, and cannot be conjured from thin air. In a world of swelling debt, digital counterparty risk, and inflating currencies, sound money acts as an anchor, a store of value that has outlasted every paper system in history. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
It's a debt instrument. Look on the bill of the U.S. dollar, Federal Reserve note. The Federal Reserve is a private corporation and a note is a debt instrument. And so when you're talking about any companies like BlackRock just recently bought a private equity company, right? And their goal is to expand into private equity. But gee, not that long ago, a couple weeks ago, actually, just before I left for my vacation, for the trip to Australia, my vacation, they were limiting withdrawals in their private equity holdings.
Yeah.
But wait, we'll get it in retirement plans. A properly diversified portfolio, and especially if you're going to have intangible assets. So whether those are stocks, bonds, mutual funds, ETFs, cryptocurrencies, all of that is intangible. If you're going to have that, you need some hard assets, sound money to properly diversify that portfolio. So yeah, this cannot be hacked, but what they do is they use the COMEX, going back to the first question, they use those paper contract markets to manipulate the visible price. They don't say this is a spot gold contract. They refer to it as gold or silver, and they can make as much of it as they want to until they can't. Remember, this whole thing is a big con game. And every con game requires confidence. And that confidence, I haven't been able to really, bear with me, because I did just get back a couple days ago. But it looks like small business confidence is down. It hasn't broken the levels yet. I did glance at that. Consumer confidence, inflation expectation, all of these things are working against the system, but they're all telling the same story.
Yeah.
And that's really that the public is losing confidence.
Right. Yeah. And I mean, we're not even that far into these rising gas prices, which affects all of that too. And yeah, we'll have to see how that continues to go. I mean, it's a whole thing, like when we're at the end of a currency's life cycle, how everything plays out. It's not just a snap of the fingers overnight, it takes time.
Right. And no matter what happens, even if the war against the Ukraine between Russia and Ukraine was over, if the war in the Middle East was over, the damage that's been done to the infrastructure and to the confidence,
Right.
that doesn't go away just like that. This is a trading market. This goes back to the other question about the COMEX exchange, but even all the NASDAQ,
Right.
the S&P 500, all of these exchanges, what are they moving on? I mean, when I looked this morning, they were very close to all-time highs.
Right. Yeah.
What difference does it make? And hey, those trading revenues at JP Morgan Chase, those trading revenues were awesome. We'll be looking at the OCC report on derivatives.
Oh, yeah.
With all those trading revenues, which are what banks count on to make their money. This is just a big trading market. Don't be fooled by the lies.
Yeah. Yeah. The Q1 report for 2026 of the OCC is, very interesting because you start to see how these banks actually operate with one another. But that's really where the interesting part comes in. Yeah, they have our deposits, but how do they deal with one another? And how they really make their money, right? How do they really do that?
But you brought up their deposits, right? And I think it's Citi, but don't hold me to that. It could be PNC. Somebody that I was listening to and I grabbed it, I just haven't had a chance to look into it, was looking at buying, one of the commercial banks was looking at buying a large regional bank for its depositor base.
Wow.
Because that's cheap funding for them. Your deposits fund their trading.
Yeah.
Right? And they can create as many of these contracts, an unlimited amount of contracts. There's no limitations. In the physical world, there are limitations, and I don't care how much there are.
Right.
There are still limitations. So just don't be fooled, because the cryptocurrencies and Bitcoin, I believed it from the minute I saw it, and I believe it today, is a Trojan horse. When they make these transitions from this current debt-based paper system into a fully digital system, which that's the rendition of a Bitcoin. It's garbage. It's designed to look like this.
They're trying to trick you with this to think, oh, look at it, it's gold, and you can touch this coin, but
it's not real. That's just a physical representation, right?
It's nothing.
Don't be fooled. It's a Trojan horse.
Yeah.
Absolutely.
The US dollar printed on that bill in your wallet is not money. It is a debt instrument issued by a private corporation. Understanding that one fact changes everything about how you see the financial system. Banks like BlackRock expand aggressively into private equity while quietly restricting withdrawals. JP Morgan Chase books record trading revenues from derivatives, not your deposits. These institutions are not managing wealth. They are running a confidence game, and consumer and small business sentiment data suggest that confidence is beginning to crack. This whole thing is a big con game, and every con game requires confidence. Meanwhile, Bitcoin is being positioned as the digital equivalent of gold, a hard, scarce, trustless asset. It is not. It is a Trojan horse, a tool designed to shepherd the public from the current debt-based paper system into a fully digital one, with even less physical grounding and even more centralized control. Physical gold and silver remain the only assets that truly cannot be hacked, faked, or printed into oblivion. Let's get back to the interview.
When I was calling up gold at $1,900 only a few months ago, everybody thought I was mad. Yeah. And when I sold out at $5 and a bit, everyone thought I was mad. It's like running against the tide gives you a certain amount of protection from the sort of mania that a lot of your viewers be worried about. It's too expensive. I agree. It's a mania. I agree. But if you don't join that party, if you don't go to Planet Madness and start buying stocks there, you're covered, aren't you? So I think that a lot of your viewers who will be gold people, silver people, who are probably very happy over the last few months, but been buying through thick and thin forever, they relate to not being, in the in crowd. And in fact, when gold and silver in particular was in the in crowd, I want to run away. I want to run away fast. You want to buy silver? Like you got a queue around the block for silver? Buy mine. I've always been saying that we're going to get elevated inflation because of what AI is going to do to, basic commodities, hard commodities, that is. And now we've got, soft commodities are probably going to go on a run now because yields are going to be down this year because there's going to be a shortage of fertilizer for the growing season. Okay. On the other side, capitalism is extremely good at finding solutions to these sort of things. And, there's normally a reasonable amount of slack so that a short term, an acute issue can be kind of, bounced across, papered over. But, I mean, this is looking like a chronic situation to me. All Iran's got to do, and it would appear to me is kind of psychologically clued up to do it, is just sit there and take the punches. I mean, if America blows up all the power stations, what are the Iranians going to do? They're not going to love America, are they? In fact, they're going to probably get in line behind their mad mullahs. Yeah. And if they blow up all the bridges, they're probably going to be more pro their crazy, horrible government than they were before it all started. And then all those people who are in charge there are going to sit in their bunker and just say, come and get us. And then what? And fly a few paper planes with bombs on them over, towards Dubai and Saudi and take out all the unhardened infrastructure. I mean, how's that going to be avoided? It's going to be very difficult for it to be avoided. So you then got a systemic destabilization focusing on Saudi Arabia, the United Arab Emirates, and probably, Iraq. That's going to drag on and on and on and on and on. That's going to be a massive drag on the world. Now, what started to happen in Europe is that they started to say things like, we're going to cut the massive taxes on your energy. And are they big over in Europe. And they're all hidden. But you look at your electricity bill and you go, hold on a minute, how much of this is not tax? Well, half of it looks like tax. Yeah. Now they're going to cut those taxes on gas and diesel and electricity to stop the peasants arising with their pitchforks and saying, what's going on? Well, that means the deficits are going to expand significantly. That means they're going to have to print money. That means there's going to be inflation. So you've got the AI inflation, and now you're going to have the energy and the budget deficit running inflation. So you're going to get reasonably decent inflation coming down the pike. So at the moment in America, it's 3% and a bit, so they say. So you can add on whatever that fudge factor really makes it. And then you can add on 50%, I reckon. So we're going to have somewhere between 5 and 10% inflation until further notice, which is going to make a mess. And it's going to be, you see, people are used to inflation being from too much money printed. Print too much money, more supply of money than a supply of goods, up goes prices. Okay. And we're all up to speed on that these days. But what we lost sight of is you can get inflation because the cost of stuff goes up. Nothing to do with money supply. The cost went up, i.e. you got poorer because now the thing that you bought from China for 10 cents is now made at home at 15. And actually now you've got a budget deficit on top of that to give you some inflation from money supply. You've got the cost of things going up. Copper's gone up, so it goes up. All those things. It's like try buying yourself a gold watch these days. I mean, it used to be you get a gold watch. Watches were gold because you could afford to have a gold watch back then. Not many people can afford 40 grand for a gold watch these days. The price of gold has gone up in real terms. Yeah. So in gold, you got poorer. So you've got the inflation behind the old too much money inflation. And then you've got the cost of things actually going up. So you've got a double whammy. You've got real price rises and you've got synthetic price rises coming from too much money. Mean that probably stacking gold is now probably back to stacking again. And I'm thinking, having got out of my gold way up from here and also silver, I'm starting to think, well, I can start to DCA again now, because it's looking like over the next 5 years.
Dollar cost average, right?
Yes,
DCA?
dollar cost averaging. I used to be able to search my name or DCA, and my name would come up against it a few years ago. But yeah, just little bit every month, boom, 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 I'm picking away at it, so that you wake up 3 years later and you go, oh, I've got quite a lot now. Rather than going, oh, I sold my house, I bought a gold bar. You just go, I'll have some again. Oh, I'll have a bit more of that. Oh, I'll have a bit more of that. Oh, I'll have a bit more of that. And, I think it's now starting to be valid again to think in those terms of starting to stack again. Yeah, I kind of am a stacker, but not like gold and only gold kind of stacker. So it's time to start thinking again as this mess in the Middle East goes on.
The inflation story playing out right now is unlike anything most investors have been trained to recognize. It is not a single wave of excess money supply. It is a double whammy. On one side, geopolitical friction across the Middle East threatens to lock in a chronic energy supply crunch, destabilizing Saudi Arabia, the UAE, and Iraq in ways that drag on for years. On the other, governments across Europe and beyond are slashing energy taxes to calm public unrest. Add AI-driven commodity demand and a fertilizer shortage already pressuring soft commodity yields, and the picture becomes structurally inflationary, not a blip, but a decade-long grind. You've got real price rises and synthetic price rises from too much money, a double whammy heading straight for your purchasing power. The contrarian play here is not to panic buy at the peak. It is to build quietly, consistently, dollar cost averaging into physical gold and silver, a little each month, until years later you look down and realize you have built something real. No single dramatic bet, no selling the house for one gold bar, just steady, disciplined accumulation of hard assets while paper systems absorb the damage around them. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.